We're seeing that rates have been left on hold at 4.25%, and that goes against almost every economist's predictions that rates would be cut by 1/4 percentage point to 4%. So a little bit of a turn up for the books. And
a surprise outcome.
Yes, a bit of a surprise outcome. I was surprised, and I was double checking my own reading of that before I said, but a turn up for the books, and the Reserve Bank had been expected to perhaps take out a bit of an extra insurance policy by cutting rates today, and also they had said on a number of occasions that they were quite comfortable about the state of inflation. And the last statement in December said they were very pleased about where inflation was heading, and that actually gave strong indications that they would cut again today. But it seems that they're taking a very strong wait and see approach to see what the impact of the previous two rate cuts has had on the economy.
Because of course I think there were one or two economists who were arguing for rates to remain on hold, but others were saying they were debating over whether it should be 25 basis points or a more aggressive 50 basis points.
Well, just looking at what the Reserve Bank has been saying in the statement, and that's just coming out over the wires at the moment, that the Reserve Bank has said that they believe that the current setting of 4.25% is appropriate for now, believes that indicators have been robust to date. We saw that yesterday there was encouraging news on employment in that private sector survey from the ANZ on job ads, showing that there is some jobs growth, more advertisements on the internet and in newspapers. There had been predictions that the unemployment rate might move to 5.5% by mid-year. That appears to have been trimmed back. So once again, the Reserve Bank quite comfortable at the moment to sit back, wait and see. And also, if you look at the global factors, the other issues that have been pushing the Reserve Bank, we've seen the jobless rate in the United States fall to 8.3%, which is very encouraging and good for global growth. And also, the situation in Europe has moved back just a little bit from the precipice. We're not necessarily going to be seeing the type of meltdown or breakup of the European Union or the Eurozone that we were perhaps fearing in December of last year. So once again, a wait-and-see decision from the Reserve Bank.
Could this be viewed as well, the RBA basically saying that the Australian economy, the fundamentals are intact, they don't need to take more aggressive action?
They'll be seeing still very much a two-speed economy, but there's a very strong pipeline of growth, particularly coming from China and India. That means that the Reserve Bank has to think about the threat of inflation further down the track, particularly in those mining, rich resources boom states.
Because inflation's fairly benign at the moment. Retail spending, we were hearing yesterday, is pretty flat. A lot of indicators were leading economists to say we needed another rate cut.
Particularly those retail sales figures that were out yesterday, showing that in the all-important Christmas month of December, retail turnover actually went backwards, down 0.1%, and that was seen by many economists as really the sealer for a rate cut today, that because of the retail situation and also the pressure on manufacturing and the number of job losses that we've been seeing, that the economy needed a bit of a kick along. But because it hasn't happened today doesn't mean that it won't happen later in the year. This wait and see approach will most likely have most economists saying that another rate cut is in store, perhaps another one before June, but just not today.